You wake up, you check the markets, and silver is trading at $100 per ounce, not 50, not 70, 100. Your first reaction would probably be disbelief, your second reaction would be regret, and your third reaction would be a question. How did this happen so fast? Right now, silver is trading in the high double digits in global markets, hovering around the $90 zone per ounce in spot trading on COMEX. That alone would have sounded impossible just a few years ago. Yet here we are in 2026, watching silver flirt with price levels that were once considered extreme. So the real question is no longer whether silver can rally. The real question is whether $100 is a fantasy or simply the next logical step. Let us slow down and examine the facts. Not emotion, not hype, data. On the futures side, activity on the COMEX has been intense. Open interest has expanded during upswings instead of collapsing, which tells us this is not merely short covering. There has been genuine participation. Volume spikes have coincided with geopolitical headlines and U.S. macroeconomic data releases. That is not random behavior. That is capital reacting to risk. At the same time, ETF inflows have quietly strengthened. The largest silver-backed ETF, iShares Silver Trust, has seen renewed interest from institutional desks. When ETF holdings increase during price appreciation instead of declining, it signals accumulation rather than distribution. That is critical. Now let us talk about the macro backdrop. The US dollar has shown intermittent weakness against major currencies as markets debate the timing of Federal Reserve rate adjustments. Whenever rate cut expectations resurface, non-yielding assets like silver attract renewed flows. The inverse correlation between the dollar index and silver remains intact in 2026. When real yields compress, silver breathes. But silver is not just a monetary metal, it is industrial. Nearly half of global silver demand now ties directly to industrial applications. Solar panel manufacturing continues expanding globally. Electric vehicle production is not slowing. Artificial intelligence infrastructure requires advanced electronics. Every one of these sectors consumes silver. That is not speculation, that is structural demand. Global mine supply, however, has not kept pace. Several major producing regions have faced operational constraints, regulatory delays, and cost pressures. Recycling helps, but it has not closed the gap. The market has recorded consecutive annual supply deficits. When deficits persist, inventory cushions shrink. When cushions shrink, price elasticity increases. Let me translate that into plain language. If demand spikes suddenly while supply is tight, price moves can accelerate rapidly. Now consider investor psychology. Silver historically lags gold in early bull phases, but outperforms dramatically once momentum builds. During previous commodity supercycles, the gold to silver ratio compressed sharply before silver entered explosive territory. In 2026, that ratio has already begun narrowing compared to prior years. That compression alone suggests silver is gaining relative strength, but we cannot ignore volatility. Silver is notorious for sharp corrections. In recent weeks, we have seen profit-taking episodes that shaved several percentage points off the price within days. That is healthy behavior in a rising market. Parabolic moves without consolidation tend to collapse. Controlled volatility suggests the market is digesting gains rather than exhausting itself. So, can silver reach $100 this year? Mathematically, the move from the current $90 range to $100 represents roughly a 10 to 15% increase. In silver terms, that is not extraordinary. Silver has historically moved 20 to 30% within weeks under the right catalysts. The percentage hurdle is not enormous. The psychological barrier is $100 is a round number. Round numbers attract attention. They trigger media headlines. They attract retail participation. They also attract profit-taking. Therefore, the approach toward 100 could be turbulent. Let us examine potential catalysts. First scenario, Federal Reserve easing accelerates. If inflation cools enough to justify rate cuts while growth slows modestly, real yields would likely decline. A weaker dollar environment combined with easier liquidity historically supports precious metals. In that scenario, speculative positioning could intensify quickly. Second scenario, geopolitical escalation. Silver reacts strongly to uncertainty. Trade tensions, sanctions, or supply chain disruptions amplify safe haven demand. When fear rises, investors diversify into tangible assets. Silver benefits from both monetary and industrial narratives simultaneously. Third scenario, continued industrial expansion. If solar deployment targets exceed expectations and EV production remains robust, industrial procurement contracts could tighten spot supply. Physical premiums would rise, futures would respond. However, there are bearish risks. If inflation reaccelerates sharply and forces the Federal Reserve to maintain higher rates for longer, the US dollar could strengthen again. Higher real yields typically pressure precious metals. Under that environment, silver could retrace toward technical support zones before attempting another breakout. There is also the possibility of demand destruction. If global growth slows significantly, industrial demand could soften. Silver's dual identity becomes a double-edged sword during recessions. Now let us talk technical structure. Silver recently tested upper resistance bands near the mid-90s before consolidating. Support has formed in the mid to high 80s. As long as higher lows continue forming, the broader trend remains constructive. A decisive breakout above recent highs could open momentum-driven buying. Algorithmic systems respond aggressively to breakout confirmations. Momentum oscillators have cooled slightly from overbought levels, which paradoxically strengthens the bullish case. Sustainable rallies require pauses. The market appears to be building a base rather than peaking. But here's the deeper issue most investors overlook: market depth. The silver market is significantly smaller than gold in total capitalization. That means incremental capital inflows have disproportionate impact. If institutional portfolios increase allocation by even a fraction of a percent, the price response can be amplified. Imagine pension funds shifting just a small allocation toward commodities as an inflation hedge. Imagine sovereign funds diversifying reserves. Imagine retail investors chasing headlines once silver crosses 95. Liquidity layers thin quickly when demand overwhelms offers. This is how acceleration happens. Yet we must remain disciplined. $100 is possible. It is not guaranteed. If silver sustains above 90 and builds momentum, the path toward 100 could unfold in stages. 95 becomes the next psychological test. A weekly close above that region would likely trigger breakout narratives across financial media. Retail participation would increase. Volatility would expand. At that stage, price discovery could accelerate rapidly. On the other hand, failure to hold above key support levels would delay the timeline. A retracement into the low 80s would not invalidate the broader uptrend, but would suggest consolidation rather than immediate breakout. Another factor to watch is options positioning. As strike interest clusters around major round numbers, gamma dynamics can create self-reinforcing moves. If call option activity increases near the 100 strike, dealers may hedge by buying futures, amplifying upward pressure. The story does not end at 100. If silver breaks convincingly above that level, the narrative shifts entirely. Media coverage intensifies. Comparisons to previous commodity booms emerge. Retail search volume surges. Momentum funds increase exposure. That phase could extend beyond 100 if fundamentals justify it. But let us remain grounded in probabilities. The current macro environment favors metals moderately. Industrial demand is stable to strong. Supply constraints remain present but not catastrophic. Monetary policy expectations are fluid. Under these conditions, a controlled move toward 100 within 2026 is plausible if catalysts align. It is not inevitable, but it is within reach. So what direction might the market move next? In the near term, expect continued range-bound volatility between established support and resistance zones. Traders will react to each data release. Employment reports, inflation prints, and central bank commentary will produce short-term swings. If macro data softens and the dollar weakens, silver likely resumes upward pressure. If economic data surprises positively and yields climb, a temporary pullback becomes more probable. In the medium term, the structural supply deficit narrative remains supportive. Unless mining output expands significantly or industrial demand contracts, the underlying foundation appears constructive. Longer term, the most important variable will be capital allocation shifts. If institutional investors increasingly view silver as both a green energy metal and a monetary hedge, demand layers could deepen. Let me ask you something. If silver does reach $100, will it be because of panic or because of transformation? The answer may be both. Transformation in global energy infrastructure requires silver. Transformation in monetary policy regimes favors tangible assets. Panic accelerates both. The market rarely moves in straight lines. It climbs walls of worry. It punishes impatience.